Hello, welcome, and thanks for joining us today as we chat all things charitable giving. So I'm going to get us started here and just do sort of a general summary on charitable giving, and then Chris is going to hop on here and talk about some more specific strategies to charitable giving. And then we're going to have Karen Hudson join us towards the end. She's from Benefaction, and she's going to speak more specifically to donor advised funds and some strategies that go along with that. Just a quick housekeeping item before we really get started here. If you have a question at any point, there is a little question box at the bottom of the page for you. You can type your question in, and then we'll do a Q&A period at the end of the presentation to address any questions that you have. Let's get started. So first, we want to start off really from the beginning. So charitable giving really goes hand in hand with philanthropy, and you hear that word a lot when we speak to that. So we want to just start off, what is philanthropy? What is really the definition there? So it's the desire to promote the welfare of others, expressed especially by the generous donation of money to good causes. So really it does go hand in hand with that. Some synonyms of philanthropy you might also hear: benevolence, generosity, humanitarianism, and altruism. So those are all some things that kind of come to mind when we think about charitable giving. For some of you, charitable giving is something that you're already doing. It's something you're already thinking about. But for some of you, this may be just a starting point. So you're really looking for where to get started and how to get into it. So here are some questions that you can really think about to start your journey on sort of getting into it. So first would be, what are your current thoughts on charitable giving? What values do you want to pass along to your family? Are there issues or causes that you're passionate about? What motivates you to give to charity? What type of legacy do you want to leave? And have you ever had a chance to review your giving to see if you're maximizing your donation potential? So those are some great questions that if you're starting your journey, just sit down and sort of, see if you can write some answers down just to get you started to see what direction you want to go in. And then the other thing that's really important to look at, so this is the pyramid of financial clarity. So the base of our pyramid would be your needs, your financial freedom. So do you have enough money to sort of carry you through your lifestyle, to make it through retirement and just throughout your life? That next step would be your wants. So those are things like helping your family. Maybe it's paying for education costs for a grandchild, or taking everyone on a vacation, or something where you're really still keeping the money in the family. And then that third step would be leaving your legacy. So that's where you're looking at helping charity. And that's sort of when an option comes into play for you. The wants and the legacy section would be your excess capital. So that's where Chris and I really work with you to do some financial planning to see where your excess capital is, and if that's an option for you, and if it sort of makes sense to reach those wants and legacy steps, and how we can work that into your plan. Next would be the benefits of giving. So why do we do charitable giving? Why is it that we want to do this? So some of the benefits that we've outlined would be making a difference in your community, personal satisfaction in the way that it makes you feel. And that's really an important one, is the benefit that you get out of it is the way that it makes you feel. Lasting legacy, and then also teaching your children the importance of giving. If you are planning to give to charity, here's a list of eligible charities. Well, actually, the next slide will talk about specifically the tax benefits. That's also a benefit that you obviously would receive. If you are looking for a tax benefit, just make sure that when you make a donation, it is to an eligible charity. So we have a list here. It's something like registered charities, registered Canadian amateur athletic associations, registered National Arts Service organizations, registered housing corps, Canadian municipalities, registered municipal or public bodies of government, registered universities, Majesty in Right of Canada, registered foreign charitable organization, or registered journalism organization. Just make sure, even if before you do the donation, do a quick Google search to make sure that it's an eligible charity if you're looking for that tax benefit. So things like when you see somebody posting a GoFundMe page, typically that's not something that you would get the tax benefit from. You can still certainly donate to it, but just remember, that's not one of the benefits that you're going to get back from that. So on the note of tax benefits of giving, what are the tax benefits? So if you donate to charity, there's the benefits you get on the federal level, and then also the provincial level. So on the federal level, it's actually broken out in two sections depending on your income. So 29% if you're making less than $214,000, and then 33% if you're making more than $214,000. And then on the provincial level, you're getting an additional 21%. So those add to, if your income's less than 214,000, you're getting a 50% tax donation receipt on that, or tax benefit, sorry. And then if your income's over 214,000, it's 54%. One thing to note, those are just on gifts over $200. So on the first $200, I've outlined the benefits in the top corner here. So it's actually 15% federally and then 8.79% provincially for a total of 23.79%. If you're really wondering what the benefit would be, there's actually a lot of charitable donation tax benefit calculators online, because it is sort of a mix of both that first 200 and then the rest. So if you really want to specifically know, you can just do a quick Google search for a charitable giving tax calculator, and you enter in all of the information of sort of how much you're donating and your income level and where you live, and it'll be able to calculate the exact amount for you. There also are some tax credit limits to your lifetime on donating. So if you're looking to do a really large donation, this is something that you're going to want to look into. Not necessarily that you have to memorize these and always keep them in mind, but it is important to speak to an advisor if you are looking to do a large donation, because you just want to make sure that you're maximizing that amount. So limits during your lifetime. So donor is limited to using in any given year a credit not greater than 75% of the donor's net income for tax purposes. If the gift is capital property, the 75% limit is increased by 25% of the capital gain arising from the gift in the year, and 25% of the lesser of any recapture of capital cost allowance on the property and the property's capital cost at fair market value. There's also limits if you're donating through your will. So limits made by will would be the donation limit is in the year of death, immediately preceding year is 100% of the deceased net income. And then if the charitable gifts are claimed in the estate's tax returns, the donation limit is 75% of the net income of the estate. Donation tax credits resulting from charitable gifts made in your will cannot be claimed by your spouse, unlike gifts made during your lifetime. So those are just some things to keep in mind. And again, just echoing, it is really important to speak to an advisor just to make sure that if any of these things come into play, you're accounting for them. This slide here is just an interesting visual that we like to show. When you're thinking of making a donation, if you're thinking about tax planning strategies and estate planning, the alternative to making donation is typically paying tax. So you sort of ask yourself the question, this is how the government is spending their money. This is the breakdown. So would you donate your money this way? If you're not looking at making a donation, you're looking at paying the tax instead. If you have that choice, is this how you would choose to donate your money? So that's kind of an interesting, just some food for thought. And now we're actually going to have Chris pop on here, and he's going to talk specifically to the donation strategies that you can use.
Well, good afternoon, everyone. Again, as Kaileigh said, thanks very much for joining us. We're excited to be putting on this webinar today on charitable giving. We're having these conversations a lot with our clients these days, and just making them aware of the options that are out there. So I'm going to talk specifically about personal donation strategies, and then for those that have a company, how they can utilize corporate strategies, donation strategies. So just a list of the personal donations, and I'll go through them kind of in depth in the slides coming up. But there's cash gifts, which are the traditional way that we would give. Somebody knocks on the door from the Cancer Society, and you make your $20, $25 donation. So it's very ad hoc, not really any planning behind it. There's no consistency to it. I remember when I was younger, my mom used to canvass for the Canadian Cancer Society. So I remember her getting her yellow folder and going door to door and looking for donations on behalf of the Canadian Cancer Society. So that's probably the majority of Canadians is how they donate. A phone call or direct mail or somebody knocking on the door. The next one would be gifts of capital property or securities. If you've got some stocks in the bank or that kind of thing, that you donate that to the charity, and there's some taxable benefits from that. We're going to talk about registered plans and some of the options you can do with the beneficiaries on your plans. We'll talk about some annuities, and then insurance involved with how you can utilize insurance in a donation strategy. And then lastly, private and public foundations. And Karen's going to come on from Benefaction to talk specifically about one type of public foundation, or private foundation, I should say, which would be a donor advised fund. So move to the next slide here. So in gifting capital property securities, it basically allows you to transfer assets at the fair market value. And fair market value is kind of what the value if you sold that stock today, what the value you would get for that, without having to pay any capital gains on the increase in value. So there's two examples here, two scenarios. One is if you donate the stock directly, and most charities are set up to receive stocks. They'll have a brokerage account where, what you would need as a donor would be the details around that account, what firm it's with, account numbers, that type of thing. But in this example here, we're using $10,000, the value of the stocks. The initial cost base is $2,000. And what that is basically the cost that you would have purchased that particular stock for. So the difference between those two is what's a capital gain. And if you are not making that donation, that capital gain, 50% of that gain is taxable. And then depending on your tax rate, you pay some tax there. So in this example here, with donating stocks directly, there is no capital gains. The inclusion rate is 0. So you get the full value of the contribution, in this case here, $10,000. And the tax credit, we're using the example Kaileigh stated earlier, the percentage is at 50%. You can see that there's a $5,000 tax saving. If you sold the stock and donated the cash, you can see there would be a taxable capital gain of $4,000. The tax on that, assuming a 50% bracket, would be $2,000. The tax credit still is the $5,000 because the donation amount is the same, but the tax saving is only $3,000, not $5,000. So it definitely is a benefit to donate stock directly versus selling them first and donating the cash. So then when we talk about registered plans, and again, Kaileigh mentioned this earlier, it's really important to kind of do this in the context of a plan. So when we do our planning, we have identified that there's going to be surplus capital in a particular estate, and it consists of a lot of that being in a registered plan. Well, that's going to provide or present a fairly significant tax liability to the estate. So one of the easiest ways to donate, it just involves changing the beneficiary on your RSP or your RIF or your tax-free savings account to the charity of your choice. And this is an ideal strategy for those that don't have any heirs, may be single, don't have sufficient funds on their own, but they don't have any heirs to leave it to. So this is an opportunity for those individuals to name a charity on those types of accounts. We mentioned earlier about the federal tax credit 29%, the provincial tax credit 21%. So those help offset the tax on the disposition. Because what happens when you pass away, assuming you don't have a surviving spouse, that the full value of what's remaining in an RSP or in a RIF is fully taxable. So on a $200,000 RSP or RIF, that full $200,000 is taken in as income and taxed as income, therefore in paying 35 or 40% tax on that. So with naming the charity as a beneficiary, the full value of that account goes to the charity. The estate receives the tax receipt for that particular donation, which helps offset or cancel out the tax that would be paying otherwise on that income. The other benefit, actually, it allows the proceeds to pass to the charity outside of the estate, which may eliminate probate fees on the proceeds. And in Nova Scotia, the probate fees range anywhere from 1% to 2%, depending on the size of the estate. The third option for personal donation is an annuity, whether it's a gift annuity or an insured annuity. And really, an annuity, it's an insurance product. And basically, it is an individual would buy an annuity, give the insurance company $100,000, and the insurance company would promise to pay for life a fixed amount of money. There's some benefits or some riders you can build in that. One would be an inflation adjusted rider, which means your payment goes up with inflation to keep in line with that. These days, that's very important. You can have a guarantee period, so a 20-year guarantee. So if something were to happen to that individual, the income would continue on to their survivor or to their beneficiaries. So it's very flexible and it's taxed very favorably. Approximately 1/3 of annuity in a non-registered environment would be taxable. So with a gift annuity, you make a large donation. The charity uses a portion of the money to buy an annuity for you, and the remainder of the lump sum goes to the charity. So it's still going to provide that income for you that you may need for day-to-day, month-to-month lifestyle, but the charity gets the lump sum benefit, which is nice. The insured annuities is kind of one extra feature, is where you would buy the annuity yourself, and the portion of the increased after-tax income would pay the premiums on a life insurance policy in the charity's name. So the charity on death would receive the full value of the life insurance as a donation, or you can gift it directly to the charity during your lifetime. There's both options. So in speaking with insurance, there's a number of different things you can look at from an insurance standpoint to benefit a charity. The first is taking out a brand new policy in the name of the charitable organization. So you receive the charitable tax rate for the cash value of the policy, and depending on the type of policy, some have cash values, others don't, or for any premiums you pay. So if you're paying $1,000 a year premium or whatever that number is, that premium payment is actually a tax receipt to you. The second is naming the charity as a beneficiary of an existing policy. So it's a good option if you already have a policy that the family may no longer need. We come across a lot of policies that have been in place for 20 or 30 years, and the need is no longer there like it was 20 or 30 years ago. So at the time of your death, the charity receives the policy proceeds and your estate receives the tax benefits. So it's a win-win for both the charity and your estate. And then the third option is to transfer ownership of an existing policy to the charity. And they would receive a charitable tax receipt for the cash value of the policy. And this would be applicable to a universal life policy or a whole life policy. It wouldn't be for a term policy, because term insurance does not have any cash value. And then if you owe annual premiums on the policy, you still pay them, but you'll receive the tax receipts in the amount of your payments. So again, a nice option utilizing insurance. So that's talking about personal strategies in giving. To talk about corporate strategies, which is not applicable to everyone. Obviously, approximately 4% of Canadians actually have an incorporated a company that they would be able to utilize some of these strategies with that. So we're going to talk about corporately owned insurance policies and what the benefits are there. Talk about donation of shares, similar to doing it personally, but there's a little bit of additional benefits doing that inside of a corporation, and then a kind of a combination of both. And we'll show some real life examples. So. Giving using your holdco, and your holdco is a holding company. A lot of companies or a lot of business owners, when they structure their business, they have an operating company, which is their day-to-day activity, of all the whatever type of industry they're in. Their holding company is another entity which has ownership in that particular operating company, but is a place where they can move profits or move assets that are going to be used for the owners of the business, either now or in retirement. So in this scenario, there's $250,000 worth of securities with a cost base of $110,000. Just like we talked about earlier, that'd be $140,000 capital gain with those particular securities. So in donating the $250,000 inside the holding company to the charity, that's an immediate gift. There's no capital gains on the disposition of the securities, just like personally. So that's a definite benefit. But within a corporation, there's something called a capital dividend account, CDA. And what that is, usually there's two main things that fund a capital dividend account. One is life insurance, a tax-free death benefit that populates the capital dividend account. But the second thing is the non-taxable portion of capital gains. And we know that capital gains are 50% taxable personally. Same thing inside a holding company if you just sold securities and used the cash. But in this case here, where you're donating the amount of the securities to the charity, the full value of the capital gain, $140,000, credits the capital dividend account, which can be paid out as a tax-free dividend to the owner. So that's definitely a nice benefit. So in this case here, the tax liability at death, because the value of the holding company has been reduced by the $390,000, which is a combination of the donation and the capital dividend. Because what happens on death with companies is that the shareholder, the owner, their shares would roll over to their surviving spouse. But assuming there's no spouse, those shares are fully taxable. In a lot of cases, those shares were established for a value of $1 or $10. And if the company is worth $1 million, there's a significant capital gain. So this strategy helps reduce that ending value of the corporation, therefore reducing the tax liability. So the second scenario is again the same strategy as donating the securities, but adding insurance to help replenish that donation amount, but also to further reduce that tax liability and increase that capital dividend account balance down the road. So again, still the same scenario: $250,000 worth of securities, $110,000 cost base. But in this case here, the corporate tax savings of about $120,000 would be used to purchase an insurance policy with an initial death benefit of $250,000. And this would be a whole life participating policy, which would have dividends that would buy further coverage or further death benefit as the owner ages. And you can see at age 85, there'd be an $850,000 death benefit. So that $850,000 death benefit, as I talked about earlier, is an amount that can credit the capital dividend account and then be removed as a tax-free dividend to Rick's heirs in this case. And again, still $390,000 of value has been removed from the company as a combination of the gift and the $140,000 in capital dividend. So this just shows a comparison on, and we look at it in the context of cost per dollar. So the first strategy was just selling the shares and donating proceeds. So the $250,000 donation after tax, it's net of $111,000. So it's about 44 cents per dollar as a cost. The second strategy was the corporate donation of securities. Again, it's a lot more favorable. It's the net cost of the gift is significantly less. The cost per dollar is less. But we marry the corporate donation of securities and the life insurance. You can see that the cost per dollar is significantly lower. So there's definitely a benefit of utilizing that insurance strategy with the gifting of securities within a corporation. So with that, I'm going to turn this over to Karen. Now, private and public foundations are another area, another way that you can benefit a charity. Both those types must be registered under the Federal Income Tax Act. But the primary difference between a private and public foundation is that a private foundation receives most of its funding and or is controlled by one person or a group of persons at non-arm's length arrangement with each other, while a public foundation is a broader source of control and funding. Donor advised funds, which Karen is going to talk about, are available through certain public foundations. So just a little background on Karen. We have a great partnership with Benefaction, which we've been cultivating over the last number of years, and that's kind of Karen's primary role at Benefaction. But so she's responsible to grow the foundation through the expansion of partnerships with wealth management firms like Assante and leading internal initiatives focused on scalable growth while enhancing their donor experience. Prior to joining Benefaction, Karen had a successful 20-year career in wealth management with a focus on market research and advisor practice management. Karen graduated from Queen's University, where both my kids have attended, with an honors in Bachelor of Commerce. She's co-chair of the CAGP Greater Toronto chapter and co-author of the first comprehensive study of donor advised funds in Canada. So with that, I will turn things over to Karen, and then after Karen wraps up, I'll jump back on and we'll entertain any questions.
Perfect. Thank you, Chris. And good morning, everyone, or I guess good afternoon where you are. I'm in Toronto today. It's a pleasure to join you here today. I'm just going to share a presentation right now. And there we go. So Chris, if you can give me a nod that you see it on screen there.
We're good to go, yeah.
Okay, perfect. Thank you. So again, thanks for inviting me to join you today. I'm always happy to talk about donor advised funds and our partnership with advisors like yourself. So we'll start with a quick, who is Benefaction? We are a national charitable public foundation. So as Chris mentioned, donor advised funds are held often at public foundations. And at a high level, our mission is to encourage philanthropy by helping affluent Canadians, their families, corporations, to maximize their charitable giving while minimizing tax and administrative burdens. And the way that we do this is we partner with financial advisors like Chris and his team to offer donor advised funds. So what is a donor advised fund? At a really high level, a donor advised fund, you can think of it like a charitable investment account that's held at an independent public charity, in our case, Benefaction. A Benefaction or donor advised funds in general, we receive donations from donors or multiple donors, corporations, and in return, we issue tax receipts for those for those donations. When a donor establishes a fund with us, you can choose how you want to name it. And then the really exciting part is when you get to grant out to the charities of your choice over time. I will give a more detailed explanation on the next slide, but that's just sort of a high level intro. I suppose the simplest way to think about it is, Chris mentioned quickly private foundations. It's like having your own foundation, but not having all of the work that's involved in doing that. And I will actually later in this conversation talk specifically about how foundations of your own and a donor advised fund would differ. The last point I'll mention is that donor advised funds are the fastest growing charitable giving vehicle in Canada. So this conversation we're having today is time and lots of people are talking about it. So how does a donor advised fund work? It starts with your initial gift to fund your donor advised fund. At benefaction, our minimum is $25,000. So once you establish the fund, you have a short agreement with benefaction, ours is 4 pages long, where you get to do things like name your fund. A number of families will do it in their family name. Perhaps it's in a corporation name, or often it's in memory of a loved one. So people take a lot of pride actually in the names that they choose for their fund. So when you make that donation, establish your fund, name it, you receive a tax receipt from benefaction for the full amount of that donation. So whether it's $25,000, $1 million, you receive a tax receipt for that full amount that you can use to offset your taxes in that tax year and the years ahead. Once that fund has been established and the donation is received, it's invested by benefaction into a separate account for your fund. And we will work with your chosen investment advisor. So if Chris and your team are working with you already, then benefaction will open an account with them to manage the assets in your account. Our investment objective really is long-term capital growth. And it's worth mentioning that any earnings in the account grow tax-free. So you've set up your fund, the dollars are invested, and then now onto the fun part, and that's granting. So a portion of your fund must be granted out each year. At benefaction, we follow the CRA guidelines, which for benefaction as a whole is 3.5% of the average fund value in a year, but we actually pass that requirement down to every individual fund. We think it's important that these funds are active in supporting the charitable sector. I will also mention that this disbursement quota is actually increasing to 5% as of January of 2023. That was part of the budget 2022. But at benefaction, I can tell you that on an annual basis overall, we disperse almost 20% of our assets. So our donors are very active in granting out to their charities. One more point I want to mention that I forgot to on the gifting portion. When you first establish your fund, you have the opportunity to name a successor. So a lot of people wonder what happens to this fund after my passing. And so you've got a couple of options. One is if you have a person in your life, a family member, a friend that you would like to carry on your legacy after you pass, you can name them as your successor. Or for anyone who doesn't have anyone in that position, you can name the directors of benefaction to carry out your wishes on your behalf. So you would share your plans with us in your lifetime, and we would carry them on for you in perpetuity, or you always have the option, and some donors do choose this, that upon your passing, you want the entire fund to be distributed out, and we will certainly respect your wishes in that respect. So that's a high level of how the donor advised funds work. And when we get to some questions in a moment, I'll certainly see if anyone has any questions on it. So one thing people do often ask is, what can I donate into my fund? And so on screen here, we're showing all of the gifts that we can accept at benefaction. So cash, that's an easy one. The publicly traded securities, I know Chris was just talking to you there about the how tax advantageous it is to donate appreciated publicly listed securities. Because of that capital gains exemption, it's a particularly tax effective way to give. It's also worth mentioning that we accept private company shares. So if we've got any business owners on the line, benefaction can accept those. It's a bit more involved, of course, in terms of seeking out evaluation, et cetera, but we absolutely do it. Your registered plans, your RSP, your RIF, TFSA, those are assets that we can accept. And then also life insurance. And I know Chris was just sharing a really interesting example with you there about how you can compound donations of securities and life insurance to have a really effective gifting strategy. And then the last point I'll mention here is estate donations. We do have a lot of donors who include their benefaction donor advice fund in their will. And so there's a bequest that they leave to further fund the activities of their donor advice fund upon their death. Oh, sorry, my mouse got ahead of me there. So we talked about the gifting now in terms of the growing piece. So when those assets are invested on behalf of your fund with your investor of choice. We're not going to get deep into an investment conversation here. I think the key points to mention is that we do use kind of a balanced approach to the portfolio. We are looking for long-term growth. These are long-term accounts that people hold. Our target asset mix is 10% in cash, 30% in fixed income, and 60% in equities. If the cash component feels high, the reason is that each year you are dispersing amounts from your fund. So these grants that you choose to make. So we always like to have some cash in the account on hand so that when donors do want to make these disbursements, the cash is available. So that's the growing portion, the investing portion of your donor advised fund. And then on to the granting. So I described earlier how moving in January 2023, that annual disbursement quota is increasing to 5%. The main question we get is who can I give to? And the answer is there's a lot of organizations you can support. In Canada, there's close to 100,000 registered charities. So any registered charity can be issued a grant from your benefaction account. And then there's other qualified donees, and sort of this slide describes some of those, certain amateur athletic associations, certain municipalities. So often there's an interesting program happening in your local municipality that you want to support, and they are often registered to receive grants. The way to know if an organization can accept a grant from benefaction is whether they can issue a tax receipt in their own right. And if they can, then we can support them through your fund. So there's lots of flexibility here. And that's the beauty of a donor advised fund is we take your recommendation on the charities that you would like to support from the funds that you have provided. So the conversation about private foundation versus donor advised fund, and Chris was commenting on that briefly at the beginning. It is a common question that we get. And so I'll start always with advantages, start with the positives. So the advantage of a private foundation, it's really suited for donors who are seeking control, control over how the assets are invested, control over the charities they're supporting. The reason I mentioned the point about investments is because all of the benefaction accounts are subject to our investment policy statement. So if there's, some, risky investment strategy that we're just not comfortable holding in our accounts, that's where a private foundation would have the complete flexibility and control to do that. Private foundations are also ideal for people that are seeking public recognition. I often joke that a private foundation is anything but private. You are a registered legal entity with CRA, and so your information is publicly available on CRA's website, including name and address of directors, which may be family members. So that's something to keep in mind. But it is often a good solution for a lot of families. In terms of a donor advised fund, where that makes sense, it's much faster to set up. So you can fill out the paperwork in a couple of days versus private foundations are these days more on the 12-month end of the spectrum in terms of getting registered with CRA. I will mention that at Benefaction, we do allow donors, if you are considering setting up a private foundation in the future, but you need a more immediate term solution, we can open we call them short-term funds, where we would open a donor advised fund that year for you, and then in the future you can fully disperse your fund to a private foundation you're setting up. We would just need to have that sort of understood and established at the outset, but it is an option. Donor advised funds are also much simpler to manage. There's no legal filings with CRA, no tax returns you need to do. All of that is managed by the sponsor foundation or by Benefaction. So it takes that, kind of that work off your plate. Another benefit people like with donor advised funds is if you do support a lot of charities in a year, you're probably getting multiple tax receipts, which as a private foundation, you would be managing all its tax receipts. Whereas with benefaction or a donor advised fund, each time you're granting out, you're not getting a tax receipt. So come tax time, it's a lot simpler. You've got that one tax receipt from your initial donation, and that's all you need to be working with. Another point is that the matter of public recognition or anonymity, many of our donors are very private. And so part of what they like with the donor advised fund is that they don't have to share their name when they're making a grant. You let us know when you're making a gift, how would you like to be recognized? Do you want the charity to have your full name and address? Do you prefer to be anonymous? You have that flexibility. And then the last point is the entry point. As I said, our minimum is $25,000. So that's more accessible for a lot of donors than a private foundation where it's suggested that you would want to have upwards of $3 to $5 million or higher for a private foundation to make sense economically. The other point that I will make about private foundations, so if there are any entrepreneurs or business owners on the line today, there are certain rules that apply to private foundations. The non-qualifying securities, so that's dealing with private company shares, and there's something called the excess business holdings regime. And so these are rules that are in place with CRA, really to ensure that the donors and any other related parties are not having an influence over how the foundation is run and receiving kind of a personal benefit from that. So there's actually rules around what percentage of holdings of an individual company's shares can be held in the foundation. And so if you are a business owner and thinking about a private foundation, you'll want to talk to your tax folks to really be clear whether a private foundation can work for you or whether something like a donor advised fund might make more sense, because then we are arm's length from the business owner and can accept those private company shares. So just a point to mention there, if that's relevant for anyone on the line. So just to wrap things up here, thinking about the benefits of establishing a donor advised fund, and there's lots of different reasons why people choose to do that. And I'm happy to discuss that further if there's some questions, but I'll just touch on a few here. So there's the tax savings. Like with any charitable donation, you receive that donation receipt when you donate to your fund, whether that's establishing the fund or over time, if you make more donations to your fund, you receive a tax receipt every time. And then of course there is the kind of extra tax advantages when you donate certain types of property, like appreciated public securities, the example that Chris was talking about earlier. Another benefit, we call it efficiency. It's really that we're all busy people, so taking that work off your plate and sort of outsourcing it, if you will, to a benefaction or another donor advised fund. So it really feels like you have all of those advantages of having a family foundation where gifts are being made in your name. You can create that long-term legacy. You can engage your family in giving, all of those wonderful advantages or experiences of having your own family foundation, but without all of kind of the effort and headache that can be associated with managing a legal entity. So it really is an efficient option for people where it makes sense. And there is absolutely an element of control with the donor advised fund. I don't want to suggest that only exists with a private foundation. With a donor advised fund, you advise on the charities that you want to support. The only reason we would ever decline a grant recommendation is if it's not a registered charity, or they're not in good standing with CRA, or they're not in that qualified donee list. So practically speaking, it is very rare that a grant is not approved. And in terms of the investments, again, we work with your chosen investment advisor, the person that you work with and trust, to continue to manage the assets. So you really do have a fair bit of control over how the fund is managed, even though legally speaking, benefaction is the owner of the fund. And of course, the final point is legacy. I think in particular in the last couple of years with COVID and all that people and families have experienced, the concept of legacy and wanting to create your own legacy and how will you be remembered. A lot of people are having those sort of introspective thoughts right now, and a donor advised fund can be a great way to do that, to establish something in your name that will live on beyond you if you wish. And you can continue to add to it over time, invite family and friends to get involved. It's a lovely way to come together as a family, as a community, to do something together. So those are some of the reasons that people choose to do it. And that's it. So those were really the high level points I wanted to cover. And really at this point, Chris and I will invite your questions. So I will stop sharing my screen so we can see full faces here, and Chris is back on the line. So we'll open it up.
Perfect. Thanks, Karen. So as Kaileigh mentioned at the beginning, there's a little quick Q&A icon at the bottom of your screen. Just click on that if you do have any questions. One question that has come through, Karen, is I know you mentioned there was no administration fees with the donor advised funds, but is there any other, obviously there's a fee on the portfolio that's developed by the advisor, but any other, lump sum fee or annual fee, anything like that with the donor advised funds?
There absolutely are. And so I'm glad you asked that question. If I convey that there were no fees, because there are, they are just typically lower than a foundation. I actually included, I included a slide in my deck. It's at the back if you'd like me to put it on screen for visual people, or I can just talk about it.
Yeah, you can put it on screen. That's fine.
Sure. Okay. Why don't I go back to doing that? And then for people who are more visual, you can see it there. So this is the what does it cost? So there are 3 different fees involved with a benefaction donor advised fund. We have an initial donation fee, which is a one-time fee that is levied when a donation is made. So for a donation up to $1 million, it's 1% of that donation. Between $1 million and $2 million, it drops to 0.5%, further drops to 35 basis points. So it's a scaling fee, and it's based on accumulated donations. So if you donate 500,000 this year, $1 million next year, you'll benefit on future gifts from that kind of sliding scale. Then there is an annual administration fee, which really covers the ongoing administration of the fund, and that is 50 basis points or 0.5% on the first $1 million, and then again, similar to the donation fee, drops as the account grows. So it drops to 35 basis points on the next $1 million and 15 basis points or 0.15% on the remainder. And that is a fee that is charged quarterly in arrears. And what's important to mention actually is any fee in the fund is charged directly to the fund. So the donor is not out of pocket in any way. The fees are drawn directly from the account, where of course your investment proceeds are accumulating as the investments are growing. And on the point of investment, there is an investment management fee, and that really depends on the investment advisor that you're working with and the investments that are being selected. So that, typically ranges from 0.5% to 1.5%.
Great.
So does that more than answer your question? Maybe too much detail, but
no, that's great. And on the side of the investments that are selected, we have kind of Assante internally has I call it a short list kind of thing of various options we have available, and by a number of different providers. CI, one of them, Fidelity's in there, Manulife is in there as well. So there's 6 or 7 or 8 different companies that we as advisors have access to implement the policy or the investment strategy on behalf of the donors. So don't see any other questions coming across, but for those that are tuning in, if you do have any questions after today's session, forward them on to Kaileigh or myself, and we'll do our best to answer it. If we don't have the answer, we'll reach out to Karen to get the answer. We are recording this, so we will be putting this on our website, as well as circulating a link to the recording. So on behalf of Kaileigh, I want to thank you everybody for joining us today, and Karen, thank you for joining us, and hopefully everyone has a great day.
Thank you for the invitation. Take care, everyone. Bye-bye.
Take care.